Welcome to the Bitcoin Unlimited podcast. I'm John Moriarty, and today I'm joined by Jonathan Silverblood, lead developer at General Protocols. Jonathan, thanks for joining me.
You're welcome.
So, generally speaking, General Protocols is in the business of designing Bitcoin Cash smart contracts. Is that right?
That is how we're going to start. Generally, we try to fill the void with things that are missing or build things that has utility for the entire ecosystem. The first product we're working on is a smart contract, and we take one product at a time. So currently only smart contracts. In the future, probably much broader.
Sure. And could you tell us a little bit about what that means generally, both maybe what kind of smart contracts it is you'll design, and then also what you hope to branch out into?
All right, so the Anyhedge smart contract, the first contract we're doing, is a contract designed to let you sell volatility risk to other parties. So if you want to stabilize your funds so that regardless of how the market moves, your funds will still have the same value afterwards, then you can take the hedge side of the contract. If you believe that the price of the market is going to go up a lot, then you could take the long side of the contract and buy the risk from the hedger so that you have more risk, but then also a higher positive outcome. In the future, we might try different contracts for other financial instruments, but we might also try to do contracts for end user consumer products like, for example, in the Bitcoin Cash ecosystem today, you have the Literal's Last Will contract. As far as I know, there are no good user interfaces for that. And there are the Mecenas contracts for recurring payments. And I think there's like 10 or 15 other contracts that you could do that aren't a financial product or aren't a speculative product at least, that might also benefit from some kind of user interface or exchange integration or similar.
Very cool. Now, the plan is to have all of your products be open source. Is that right?
Not all of them in
Okay,
all
sure.
cases. We are making open source tooling, and we are sharing some of the parts that we do. But there are also some parts that are proprietary, and if we gave them away, we wouldn't have a business model. So, for example, for the Anyhedge contract, the contract itself is free. The white paper explaining how it works is free. And we have built a library that makes it easier for some developers to interact with it and build tools and products on top of it. But the contract itself isn't automatically self-executing. It's just a lock script that says when you can or cannot spend funds. In order for the contract to have life, so to speak, and to behave and do things automatically, you need a third party that can monitor the contract and when the right time comes, trigger the code within it. So for the Anyhedge contract, we are acting as a settlement service. So exchanges allow the customers to enter the contract and we automate the contract behavior.
Gotcha. And so that is where the business model comes in. That is a service that you'll provide.
Yes, for the Anyhedge contract, we are acting as a settlement service provider. So we're selling automation and monitoring software. And in the future, we hope to be building on top of the Anyhedge contract and see if we can sell integration services for things like payment terminals or other places that might want to be able to automatically enter contracts.
So you mentioned earlier user-facing or end-user products, but it sounds like for this sort of thing, your customers will be businesses, won't they? Exchanges, things like that.
For these things that I described here, yes, exchanges or businesses or over-the-counter trading desks and similar will be our primary customers.
And there's even a decentralized exchange, a forthcoming one that is all set to use the Anyhedge smart contract, isn't there?
Yes, D-token is a coming exchange. It is a non-custodial. I don't know if you would call it decentralized because they have a central party that helps coordinate, but the central party does not take custody, so all funds remain in the hands of the user, and that is the benefit, so to speak, of it.
And could you elaborate a little bit on what the difference is on a technical level between an entire exchange being decentralized versus it simply being non-custodial?
All right, so when you have a non-custodial exchange, you go to a central party like a website, or you start an application on your computer that interfaces and talks with a backend server. So all data and all communication goes to this coordinating third party. They build the user interface, they build the experience you're going to have, they safeguard the access, they give you statistics and logs about things. When you have a fully decentralized exchange, there is no coordinating party. You essentially broadcast to the world, or you talk with other people who relay information, much like the Bitcoin network, where there are servers out there and they are coordinating, but you can't go to the Bitcoin server and start. You need to talk with and communicate between the servers.
Gotcha. Sorry, go ahead.
So a fully decentralized has the benefit that no one can stop you from taking part in it, because there is no party that can tell you when you're welcome or not. While a non-custodial can tell you that we don't want you here, or sorry, we can't do business with you, but they can't take your funds because they don't have your funds.
Right, and just to be absolutely clear, that's in the case of the decentralized exchange, it's maybe obvious, but we should point out that's also the case there, that no one has access to your funds, right? Or no one else.
I would assume that would be the case for pretty much all cases, but it might actually be possible to build something that is decentralized, but where you offload or sell custody because you want someone else to take that on as a service. So I can't guarantee that there are no such cases.
Well, I appreciate you're making the distinction. So this recent DeFi craze, DeFi might be the biggest buzzword since ICO, but I'm willing to bet like not many people know what it stands for, let alone what it means. Would you categorize general protocols as being a part of the decentralized finance movement?
I don't know, because that depends on what we're going to do going forward. I would say that the Anyhedge contract and the structures around can be used as part of a decentralized finance product, but we haven't implemented it as such yet. We are currently just making it as a non-custodial exchange product.
Very good. And so let's talk a little bit more about Anyhedge. You gave us a bit of an intro, saying that people can take positions on things, and you mentioned derivatives on the site. So could you explain for the less financially literate among us, what does that really mean to sell risk, or what is a derivative, and how does that work with Anyhedge?
All right, so I'm going to preface this by saying that I am not a finance person. Right? I don't have economic studies in my background. But I think an easy way to explain it is that if you have $100 worth of Bitcoin Cash today, and you're wondering, what will this be worth next week? And the price can either go up, it can go down, or it can stay roughly the same, right? So you're taking a risk that the price will move. I call it risk because it can move in an unfavorable direction. The price could go down. Now, that risk also comes with a chance of actually going up, which is a positive perspective from it. And if you don't want to take that risk, if you want to have your $100 worth of Bitcoin today and $100 Bitcoin worth next week when you intend to spend them, then you need to find some way to take this risk and get rid of it because you don't want it. One way that is popular to do this is to simply sell your Bitcoin Cash. If you sell your Bitcoin Cash, then you get $100, and, well, next week there's still $100 because the $100 doesn't have this volatility risk. Another popular way to do it is to exchange your Bitcoin Cash for a stable coin. And that way you might have like 100 USD tethers instead. And they are not supposed to go up and down in value, but there is a central party somewhere and there is someone to trust, so there is a slight risk from that perspective. What Anyhedge does differently is that it lets you stay in the ecosystem, right? You don't sell your Bitcoin Cash. You just say that I have $100 worth of Bitcoin Cash now, and I want to have $100 worth of Bitcoin Cash next week. And you find someone else who is willing to take on the volatility risk, someone who believes that the price is going to move in a favorable direction for them, and they end up taking your risk as well. From a practical standpoint, you could see it from the other person's perspective as the one who's going long on the contract. So you have $100 worth of Bitcoin Cash, and you strongly believe that price will go up soon, right? You think it's going to be like $150 next week because you have this insider information, or you've recently listened to what the developer said and you find it really, really engaging. So you want to take a risk, but you only have $100 and you're really certain of yourself. Now, if you could buy other people's risk, then you would be able to get out more than that $50 increase from that $100 you have if the price goes up $50. Like, if you just hold the Bitcoin Cash and the price goes up to $150, then you have $150. But if you enter an Anyhedge contract and you buy another person's risk, then when the price goes up those $50 to $150, you might be sitting on $300 next week instead.
Sure. Could you explain a little bit about how that works? Because it almost seems like, the math shouldn't work out. So how can someone end up, and I'm sure there's ways it works out. I mean, maybe this is where words like leverage and things like that come into play.
Right. So essentially there is leverage on the long side. From a mathematical standpoint, the hedger puts in some amount of satoshis into the contract that at the start of the contract is worth $100. And after a week, or earlier if you hit the edges of the contract where it liquidates, you look at the contract and you say, in order to get $100 worth when the price is something other than what it was before, you calculate how many satoshis do you have to give back to the hedge. And then you give those satoshis to hedge, and all the satoshis that are left in the contract, you pay out to the long, the one who speculated. So if you want to have a large amount of volatility protection, or you want to sell a large amount of volatility risk to someone else, then the long person has to put in a lot of funds and their leverage becomes smaller. But if you just want some protection against volatility risk, let's say like, I'm okay with the price going up and down 5%, but I'm not okay with it going up or down 10%. That's my limit. At 10%, I don't think it's going to do that, so I'm not going to pay for ask someone to be alongside to cover for up to 10%. Then, if you put in $100, the other party puts in some 10% something instead. And if the price goes down and goes down those 10% in units, then the entire contract pays out to the hedge. He gets all the funds. And if the price goes up, then depending on how you configure the contract, you can either hit an upper ceiling in which all the money goes to the hedge, to the long, not the hedge, or you could have a really, really, really high top and you wait for maturity, and when maturity comes, you give the hedge the amount of fiat value they wanted to have, and you pay out the rest to the long.
Okay, and just to make sure that I'm following along here, it seems like what you're saying is that it can be set so that if the change in the price is significant enough in one direction, even if it's not a 100% change, obviously, it will be 100% of the amount that goes to one side or the other. Is that right?
Yes. So another way to see it is that, say that Bitcoin Cash is worth $1, because it's easy math when it's number one. And you have $100 worth of Bitcoin Cash, so you have 100 Bitcoin Cash. You put those 100 Bitcoin Cash in the contract, and you find Long who wants to buy some volatility risk. And he puts in 20 Bitcoin Cash on his side. Right. Now, if the price goes down, you only have 120 Bitcoin Cash in the contract. So when 120 Bitcoin Cash is worth a $100, which is something at 0.8 or some such, at that point, the contract doesn't have any more fund to continue to operate. And if it doesn't pay out at that time, you end up with slippage where you might not get the entire funds back. And that's why the contract liquidates at that point and gives all the funds to the hedge.
Gotcha. So I guess that's important to point out. You've got the two positions, but if the one position is the 100 Bitcoin cash, there's another amount that gets committed to the contract, right?
Right.
That's that 20 you were talking about.
Yes, the long party of the contract, the one who wants to buy your speculative risk, he puts in enough funds to give you a certain amount of volatility protection. And if he's betting right and price goes up rather than down, then he gets a bunch of your funds because you don't need them anymore, because you are okay with a less amount because that has the same fiat value as before.
Very cool. Well, thank you for walking me and our listeners through that. So the prices obviously will need a source of some kind, and that's where oracles come in, right?
Yes, that is correct.
So could you talk to us a little bit about that?
I'm going to jump back, actually, and I'm going to go through some contract details. So
that'd be great.
The contract has three parties. It has a hedge that wants to stabilize their funds, a long that wants to increase volatility in funds, and a price oracle that supplies this price information. It also has three different ways that it can, three different outcomes it can have. It can mature, and that means that the time of the contract, say 1 week if you wanted a 1 week contract, is up, and it pays out according to the price at that time. It can liquidate, and that means that the price moved so much that the amount of money that was put into the contract in order to cover the volatility risk is too high, and the contract liquidates and all funds moves in one or the other directions. And there is also a mutual redemption mechanic, the third way to exit a contract, and that is if the hedge and the long both signs the outcome that they want and they sign the same outcome, then they can pay out the contract according to their coordination. So this oracle, the oracle in Anyhedge is essentially just some price information and a signature over that information to prove that it hasn't been tampered with. When you enter into a contract, you choose which oracle to use. And inside the contract, the oracle pricing information is looked at, and the signature for that information is verified against the oracle that the contract is for, to make sure that no one just creates numbers out of thin air. I think maybe you can ask some more questions, because I'm feeling a bit stuck here.
Sure. Well, maybe a good place to go then is to ask, who do you expect will act as oracles? Was this something that General Protocols is likely to do, or do you expect third parties to come into the mix? And if so, what's in it for them for providing that data?
All right. So good question. The target is that there should be a third party that provides the oracle service. The likely third party to do this is a third party that either has a good access to the price source, right? They have the information firsthand and doesn't need to get it from someone else. And that could be exchanges, because they have pricing information directly on their order books. Or it could be people like BitPay, who are doing price aggregation and has pricing they need for other services. For the question, what's in it for them? I assume that when an exchange launches a contract service that relies on an oracle, they are going to need to pay someone to run that oracle. For Anyhedge, the first iteration, we are going to be hosting an oracle ourselves at General Protocols. And this isn't because we think it's a good idea. We think it's a bad idea. We shouldn't be the one to hold that information. But the ecosystem is still quite young, and despite our efforts to try to find someone who is willing to work with us and build and host an oracle, we haven't found anyone who wanted to take that on yet.
Very good. So in the long term, I guess this is half a question, half just a correct me if I'm wrong. So if it's, say, an exchange that's acting as an oracle, could you say that the incentive for them to do that is that they will be able to then offer these sorts of contracts to their customers, and it is therefore then in their interest to basically provide the Oracle servers for free, because they'll also be enabling the Anyhedge contract?
That is one way to look at it, and I don't think that is how it's going to play out, because I don't think Oracle services for free is how it's going to play out. I think exchanges are going to offer Oracle services, but I think they are going to offer them on licensing schemes, like we provide this service, you pay some X amount of money every month. And those who pay that money are the ones who get the data and can build services with the data. And if we look at the ecosystem today, we already have this, but not in the structure and format that Anyhedge needs. For example, CoinGecko, and there are tens, if not hundreds, of different other websites that lists Bitcoin prices and sell that information as an API service to consumers. We looked at a lot of them when trying to figure out how to build the Oracle for ourselves. And what's worth mentioning is that if you're just making an API that someone can query, like, I want to know what the price is right now, and they ask and they get an answer, then the cheapest and shortest and easiest way to do that is to simply have no security, right? Just they ask the data, you give them the data, and perhaps you can have a token of some kind to say that this is me and I have paid for it. But I believe that when the data is properly signed and you distribute it to a large scale, then you should be able to monetize it and ask for funds to continue to run your Oracle. Like, if it has value, someone should be willing to pay for it.
Sure. So getting back to then the Anyhedge product itself. Now, at least from the general impression I've gotten from the website and discussions, is that the goal is to allow you to take a position not just on Bitcoin Cash, but on anything. Is that correct?
That is mostly correct. It's
okay.
Anyhedge, or the contract structure of Anyhedge, is going to be able to do this. But the first release of our product is going to be Bitcoin Cash focused. So in order to build, so you can take a position on absolutely anything, you need some certain criteria to be met. Like, you need a price source for that anything. And since you're going to move
volatility... Could you say that again? You need a what?
A price source.
Oh, price source.
You need a price source for the thing you want to speculate on. And you also need to consider that every separate entity has their own separate volatility risk. So if you want to speculate on oil prices in terms of Bitcoin Cash, then since both oil prices and Bitcoin Cash can go up and down, but you choose to measure them in something like dollars, then you now have two volatility risks that you need to manage. And it's technically possible to build contracts that manages both those volatility risks. And I think we will be building some interesting markets with that in the future. But the first Anyhedge product is going to only work with Bitcoin Cash and US dollars.
Very cool. So there are, of course, all sorts of markets like this already in place throughout the world today. Are there any basic examples that come to mind as far as as far as assets that you imagine will be the first ones that people will want to price, but say when you have the option to use both Bitcoin Cash versus US dollars versus the third asset?
So that is such a broad market that I have no clue.
Sure. I mean, I guess, and just for the sake of our users, correct me if I'm wrong. I mean, it could be oil, it could be corn, it could be really literally anything that has a price, right?
Right. Let's say it like this. Let's try to look at who the potential users could be. say that you are a corn farmer, right? And you have a fantastic yield of corn right now. But you don't know if there's going to be demand for all that corn. So you want to stabilize the value of it now, while there is demand, so that you don't have to sell it later at a worse price when you believe the demand might have dropped. That demand change, like demand is high now, it's low then, that is a volatility risk. It's a volatility of demand. And the structure of the Anyhedge contract could let you manage that volatility. So everywhere...
sorry, go ahead.
Yes, so everywhere in a market where you have varying demand, be it in oil, be it in corn, be it on Coca-Cola, be it on weapons, be it on whatever you can imagine, that there is production on one side, there is demand on the other, demand fluctuates, but production has like a top capacity, it can produce all it wants, then getting a stable price gives stability to the producer. It's similar to how mining and hash rate functions, in the sense that a miner, they don't want a fluctuating price, unless it goes up, of course, but generally they don't want that risk, they just want their money. So they have electricity and personnel and other costs. Those numbers are pretty much fixed, and then they have the output afterwards. And if they think like the future is uncertain, then they should want to stabilize against that future so that they don't take the risk.
And given what you've just said, I'd like to maybe point out that some people might default to hearing about a product like this and 100% equate it to gambling. It's like, oh, it's just another way to gamble. But the ecosystems you're talking about, where there's supply and demand and the desire for this stability, it's really much more than that, isn't it? It's much more than just gambling.
Well, let's say from the long's perspective, the one who wants to gamble, then it's absolutely a gambling product. But from the hedge's perspective, who wants to sell their volatility risk, it has nothing to do with gambling. They just need a counterparty who is willing to take the risk.
Right, and that's valuable. The fact that there are going to be people who will want to speculate, and the fact that there's another group of people that have assets that don't want to speculate, it seems like a pretty good match.
It is. We believe it has significant potential. Let me try and paint you a picture. Currently, on the cryptocurrency ecosystem, you have valuations and market caps. And the majority of the usage for cryptocurrency, the vast majority actually, is speculation, right? There are some parts, there's some subcultures within the crypto ecosystem that tries to focus elsewhere or thinks that like this is the important part and refers to something other than speculation. And Bitcoin Cash is a prime example of that. Bitcoin Cash tries to focus on commercial adoption at the merchant level, but we don't have that many users who go out and try to buy things. Like the network effect of users who want to spend to buy things is relatively small compared to the network effect of the people who want to fun enough who want to hedge against volatility risk because their local fiat currencies is under danger. Like Venezuela, and now people are talking about how the US dollar might have issues in the future because they're printing too much, and how there are capital controls in India and China and so on. So if we establish that speculation is actually the larger use case, then Anyhedge as a product caters to the correct or the larger network effect. Like it makes Bitcoin Cash more valuable because it can be used for that. Now, if you were to make one change to Anyhedge from what it is today, which probably would require some slight adjustment of the protocol limitations we have today. For example, it might need a little bit more size for the script. then you could essentially make the Anyhedge contract themselves transferable. And with transferable, I mean that either side of the contract, either the hedge or the long, could decide to sell their position to someone else without ending the contract, just making the contract pay out to someone else so they can get funds outside. What this change effectively does is that it makes contracts act like bills or like money. And you can start circulating the contracts themselves as currency, which means that Anyhedge can become a stablecoin. But a stablecoin where every single bill has their own counterparty, so you have no systemic risk. And a stablecoin where there are no central party that can break it, because every single contract is separate.
That sounds incredible. So is that the sort of thing that could be implemented on the individual user wallet level, where they have these contracts that then they could transfer ownership of as payment, directly at a point of sale system?
So the short answer is yes. And the long answer is there's a lot of work left to be done before we can build enough infrastructure to support that use case. The only thing that I know of that is technically holding this back is two things. The first is that we need more efficient script. There are script limitations that says you can only have so and so many bytes on the stack, or you can only have so and so many bytes in a script. And those are just slightly too large by like 10 or 15%. Right? Not a large amount, but very, very little. And we can get around that in many different ways. For example, we can make the transaction introspection native, so we don't have to spend about like a third of the contract doing a hacky workaround in order to verify and validate the parts of the script that we're interested in. Or we could add big number support, so we don't have to do some funky math in order to overcome the limitations of Bitcoin, and therefore save a couple bytes and make that possible. The other limitation that it's preventing it is that we don't have a good payment protocol. Right? We have no agreed upon way to have a wallet client and some merchant or payment software or whatever create the kind of exotic and, bluntly put, brilliant contract structures and payment structure that's possible by the Bitcoin protocol, because the payment protocols we have today are very, very limited, and they're very single-minded and naive, and they only go for one specific use case. And the use case is transferring native Bitcoin Cash X amount to a specific address, and the address has to be one of a few specific types. So it's possible to do. We hope to work our way to actually doing it, but you shouldn't expect it to come this year.
Sure. And so are there things that need to happen on the protocol or just lower levels for those payment protocols to exist, or is that just work that needs to be done, design work, engineering?
I think it's almost exclusively just work. I think it is as simple as that. But I guess that when you do that work and you try to find all these things you need to support, you might realize that there are things what one could have missed, because we don't have much research into that area.
And you're saying those things that were missed could be things that require changes to other parts of, or maybe not the protocol, but changes or work in other areas.
But I can say it like this. From all the time that I have spent looking into it, I haven't found any technical issue with the protocol that prevents such a payment protocol. But I haven't also fully built such a payment protocol, so I don't have implementation experience from it, and I haven't specified it in a specification. So I haven't really found all the edge cases.
Sure, that's very reasonable. So before we wrap up, I would like to talk maybe a little bit about how you mentioned, okay, so if there are all these different Anyhedge contracts circulating, working almost as their own stablecoin, but with each with its own separate counterparty, you said that eliminates systemic risk.
Right.
Do you have any good examples of where systemic risk is a problem,
All right.
where people could understand what benefit that brings to not have that systemic risk?
Do you remember the DAO hack? The
I
decentralized organized identity in Ethereum?
generally
One of the
aware that it
first.
occurred.
All right. So that is a smart contract on Ethereum. And people put money into it, and it's a single contract, just one contract, right? It's not one contract per person who uses it. It's a single contract that people put money into. And it had an issue, and every single user were affected by that issue. Now, Ethereum has done a lot of work to become a smart contract platform, and they have done things differently from Bitcoin and Bitcoin Cash. And it comes with a lot of things that makes contracts easier, like they have state, which is nice. But it also comes with some default assumptions, like pretty much everything you see on Ethereum that is smart contract based is a single contract. And they are, by definition, single points of failure. So go out and like Google for DeFi hack, and you will find tens, if not hundreds, of failed DeFi projects on Ethereum, who all failed because their contract or some part of the contract was abused. Now, on Bitcoin Cash, we have a UTXO model, and when you lock the funds in a contract, you don't disclose the contract rules. You only create a hash that the contract rules has to resolve to afterwards. So every single Anyhedge contract that is on chain that hasn't been redeemed yet is mostly indistinguishable from other contracts on chain. And even if you could pinpoint to say that this is an Anyhedge contract, you can't know what the parameterization for that contract is. So if you do find some bug or some abusable part of the Anyhedge protocol, then you would also need to collect and locate where all the contracts are, and you would have to find out who the parties, not specifically who the parties are, but how they did their contract, like what the peculiarities of their contract is, in order to abuse that specific contract.
Sure. And so, just to reiterate, so when the contract exists, you're saying it's stored basically as a hash, and so there's no way to go backwards from that and say, this is the type of contract, these are the requirements that are needed to resolve the contract. That's just not something that's available to someone looking to make or to abuse it. Is that right?
Yes. And there are also some other details to this. For example, you can't look at the chain and say there is this and this much money locked up in our contract, because you can't point and say which contract are Anyhedge contracts. But on Ethereum, you can say how much money is locked up in, say, Uniswap, because they have a contract. You can look at that contract address and you can see the amounts. That means that there is a much stronger incentive for people to go after the Ethereum-based contract, because all the funds are in the same place and it's a single source for the script. While Anyhedge, every single contract is completely unique. This also means that if we do find something that is wrong with an Anyhedge contract, then all contracts that have already been redeemed are safe. And you can update the Anyhedge contract code, and all new contracts you do will use the new code instead of the old code. So only the contract during the window of vulnerability actually has the issue. And for those contracts, you can't know how much funds they have, you can't know which contract they are, and you can't know which parameters they use, so that it's difficult to abuse them. The UTXO model, from my perspective, is significantly more secure, and it's just more difficult to build, I guess. That's one of the trade-offs, because you don't have access to a lot of the convenient things that Ethereum can provide.
Sure. And while, of course, there's always going to be trade-offs, that does sound exceptionally robust, especially given, the several times that big contract failures in Ethereum have been in the news.
Yeah. I noted that we have talked very much about the Anyhedge, our first product, but we haven't really talked much about General Protocols, the company, or the people.
Oh, sure. Yeah. Mm-hmm.
So I would like to say that General Protocols is a company. The people in the company have been around for a very long time, but the company has been in the making for 2 years now, and it's only the last half of those that we have had funding. So that is one of the reasons why we haven't had a product like last year out. We also we call ourselves General Protocols, and the protocols part here is for a reason. Like, we released the Anyhedge white paper and we released the Anyhedge contract. We have released a draft spec for our Oracle. We released Oracle libraries. The things that we do that are reusable and beneficial to the community, that we believe that others are going to replicate eventually, regardless of if we try to hide it or not. We are putting those forward to the community because we want to grow with the community, right? We don't want to benefit from the community, we want to benefit with the community. And we also think it's important that in order for Bitcoin Cash as an ecosystem to grow, it needs to be profit-driven, right? It can't be kumbaya and just happy thoughts all day long. So at General Protocols, despite the fact that we don't really have much money, we have for a long time now been having a sponsorship program where we fund the infrastructure that we depend on. For example, we have used both Spedden and CashScript in our contracts, and that is two tools to work with the contract ecosystem. And since they are valuable to us, and we don't want them to fall into disrepair and be unmaintained, we regularly send money to the developers of those tools. And we do the same for BCHD, because they provide us some toolings, and among the toolings they provide is the MEEP transaction debugger, which we really, really enjoy having. We wouldn't want to be in this ecosystem without such a tool. We use some wallets for different things, like we're prototyping with tester transactions and whatnot. And wallets that doesn't have funding go into disrepair and become unusable and unmaintained. So we're sending some funds every now and then to developers behind the tools we use. And I'd like to encourage other people in the ecosystem that have profitable companies or have companies that could become profitable, but only if they can actually rely on the tooling, to try to learn from this and try to help us with this, because we have limited funds, but we do give as best we can. But if all of the companies in the ecosystem that benefits from the tools all gave just a small amount in support for the tooling, that could go a long way.
Sure, and not only could it go a long way, it would pay off. It would be a profitable move for all of those companies, wouldn't it? At least in the long term.
Yes, because the better our contract scripting tools are, for example, the more people will enter the ecosystem as contract scripters, people who work with contracts. The more eyes will be on the various contracts that exist, and the sooner and easier we will find eventual problems with it. It will also be easier to source talent for your companies if the talents actually exist in the space because you have supported it. And when you're talking about having a product in the ecosystem that you sell to the community, in our case, we sell the Anyhedge product to users. You kind of need to have the users, right? You need to have this network effect. And to get users into the ecosystem, you need to make the ecosystem valuable. So by supporting the things that you use, you indirectly support the growth of the ecosystem as a whole, which gives you more customers to interact with and more profit opportunities.
Sure, that sounds like a very reasonable system and expectation, and I hope that things do work out that way. I'm sure that that they will, at least in the long term. Businesses will find out that it is in their long-term interest to invest in all of those things that you've just mentioned.
Yes.
Well, thanks again, Jonathan. I appreciate I especially appreciate your willingness to stop me there and share that. Is there anything else that you'd want to get to before we finish up?
No, I think I'm good for now. I have some more things to say, but those are going to come out in an article in a couple of days.
Okay, that sounds good. Well, thanks very much. And to our listeners and viewers, thanks for tuning in to the Bitcoin Unlimited podcast. Make sure to subscribe to our YouTube channel and hit the bell icon so that you're notified when we upload new videos.